Hi everyone, welcome to my video. I'm Claudya Hutabarat, the MBA regular student at IPMI International Business School 2021. I'm here to mind map about my learning journey in corporate finance class taught by Professor Sembel. Using this mind map, I will try to explain the learning process and things that were really useful for me to understand what makes up corporate finance. May you enjoy the content and don't forget to leave likes and comments down below because that will mean a lot to me. So at IPMI, I studied corporate finance for 8 weeks, and the course were broke down into different topics each. I learned about financial management on the first week, capital budgeting on the next. There's also topics about security analysis, capital structure, fraud management, corporate restructuring, and international finance. And the learning journey also were made fun because we also get to learn from a financial movie and conduct review on that. Now, without further ado, let's just jump right in to each topic. So on the first week of the corporate finance class, I'm learning about financial management. When learning about financial management, I also learn about value creation, good corporate governance, principal agent problem, and 5 business essentials, which I will explain to you on the next segment. So what is a financial management? Financial management is an orchestration of internal and external financial resources towards significant and sustainable value creation. Financial management includes managing capital structure, means that lower debt to equity ratio, working capital management, asset structure, revenue management, cost management, cash flow management, growth management, and risk management. All of this we need to manage to achieve a significant and sustainable value creation. But what is value creation exactly? So value creation is one of the goals in financial management itself. There are 4 cornerstones of value creation. The first one is the core value principle, which is driven by growth, returns on invested capital, or ROIC, and cash flows. The second one is the conservation of value principle, where without growth, ROIC, and cash flows, there will be no value created. Value will only be created when companies generate growth or ROIC higher than VACC and eventually led to higher cash flows. The third one, expectation treadmill principle, which means the company's overall performance equals to the expectation of the stakeholders and fundamental performance. And the last one is the best owner principle, where the business values depends on who owns and or manage it, since different owners have different strategies and unique abilities to add value. In financial management, numbers or figures are equally important to the story and the people behind the company, which brings us to the good corporate governance topic. Good corporate governance, or GCG, is a structure and mechanism of governing company management to produce a sustainable long-term economic value for both shareholders and the stakeholders. The principle of GCG can be classified as tariff, which are transparency, accountability, responsibility, independency, and fairness. The implementation of a good corporate governance principle can contribute in improving companies' performance. After GCG, in corporate internal relationship, there's also something known as the principal agent problem. Principal agent problem is a conflict in priorities between a person or a group and the representative of authorities to act on their behalf. Principal agent problem can be caused by conflict of interest, asymmetric information, and moral hazard. An agent may act in a way that's contrary to the best interest of the principal. For example, there's a conflict between shareholder and manager, where the shareholders hire the managers to operate the firm, and the managers might not act in ways that maximize shareholders' wealth. But as Prof Roy mentions, there's no bulletproof solutions for this problem. Each principal agent problem must have integrated solutions, depends on the severity of the problem itself. So, at the end of the first week, Prof Roy concludes the lecture by quoting Professor Rancharam from his book, What CEO Wants to Know. The book mentioned about the 5 business essentials, which are cash, profit margin, velocity, growth, and customer focus. These are 5 factors should be owned by the firm to succeed. So that's what I learned about corporate finance class week 1. Now, let's move on to the second week of the corporate finance class. On the second week, I learned about the capital budgeting topic. This topic is very interesting to me because with capital budgeting, we can put a planning process for investment in long-term assets and decide if the project is good or bad. And it also provides a real example of application of the time value of money. The time value of money is the concept of that a sum of money is worth more now than it will be at the future. This is due to its earning potential. The time value of money is important in capital budgeting decisions because it allows business owners to estimate cash flows for the passage of time. This process known as discounting to present value, and it allows the preference of dollar received today over dollars received tomorrow. There are ways to evaluate project in capital budgeting. The first one is the payback period, or how many years does it take to cover the initial investment. But the weakness of this type of evaluation is that it does not consider the time value of money, the required rate of return, and all the cash flow from the project. The second one is the net present value, or NPV. NPV is the difference between the present value of cash inflows and the present value of cash outflows over a period of time. If the NPV more than or equal 0, we can accept the project. The third is the profitability index, or PI. PI is a measure of a project or investment attractiveness. The PI is calculated by dividing the present value of future expected cash flows by the initial investment amount in the project. If the PI is more or equals 1, we should accept the project. Below that, we should reject. And the last one is the internal rate of return, or IRR. The internal rate of return is a metric used in financial analysis to estimate the profitability of the potential investment. IRR is a discount rate that makes the net present values of all cash flows equal to 0 in a discounted cash flow analysis. If the IRR more or same as the required rate of return, we can accept the project. If less, we should reject. The similarity of NPV, PI, and IRR method above is that the three are considering the time value of money and the required rate of return, although NPV is a better method for project evaluation. After learning about capital budgeting, we can move on to the next topic. On the third and fourth week, I learned about the security analysis. Security analysis is about learning the outside perspective of the investment strategy. In conducting investment strategy, we have to understand first the framework of analysis, which includes fundamental analysis, technical analysis, and risk and volatility. We will also learn about the portfolio theory, which I will go through one by one after this. First, the fundamental analysis, which includes the domestic and global economic analysis, industry analysis, company analysis, and the historical trend. Fundamental analysis can be done through comparing between the intrinsic value, or IV, and the market price. Intrinsic value is the measure of what an asset is worth. IV, or intrinsic value, usually discounted the future cash flow. The decision is if the IV is higher than the market price, means the stock is worth buying. If less, then we should sell. And if the IV is equal to the market price, we should hold or fairly price the stock. The second one is using financial statement analysis, where we conduct the ratio analysis based on balance sheet, income statement, and cash flow statement to find the company net worth and profitability, which measured by the return of asset, return of equity, and the liquidity of the company, which measured by the current ratio and quick ratio, as well the activity, which measured by total asset and total asset turnover, and the financial leverage, which measured by debt to asset ratio and debt to equity ratio. Market ratio, which measured by the dividend yield, price earning ratio, and how it performs towards the industry benchmark and overall historical trends. The third one is using the DuPont analysis. DuPont analysis is used to evaluate the component parts of the company's return on equity. This allows investors to determine what financial activities are contributing to the most change in ROE, whether it's the net profit margin, total asset turnover, or the financial leverage. But the ratio analysis itself has the weakness and limitations because it is has seasonality. It can be window dressing, and there's difference in accounting practice. Also, industry average are not the goal. And if we look at the data of the balance sheet, sometimes the market value is different from the book values. Older firms can look better than newer firms, and also it does not focus on the cash flow. The second one is using the technical analysis. Technical analysis is usually done by looking at the momentum versus reversal, trend, which is uptrend or is it downtrend. There's support, there is gaps such as common, breakaway, measuring, exhaustion gap, the moving average, and the triangle, which are whether it is symmetric or asymmetric. The third one is the risk versus volatility. Every saving and investment action involves different risks and returns. In general, financial theory classifies investment risk affecting asset values into two categories, systematic risk and unsystematic risk. Systematic risks, are also known as the market risk, are risks that can affect an entire economic market overall or a large percentage of the total market. Market risk is a risk of losing investment due to factors such as political risk and macroeconomic risk that affect the performance of the overall market. Meanwhile, unsystematic risk is the category of risk that only affect an industry or a particular company. Unsystematic risk is a risk of losing an investment due to company or industry-specific hazard. For example, include a change in a management, a product recall, a regulatory change that could drive down the company's sales, and a new competitor in the marketplace with the potential to take away market share from the company. Investors can use diversification to manage the unsystematic risk by investing in a variety of assets. In mitigating the risk, we can also use the capital asset pricing model or CAPM. Chatham described this relationship between systematic risk and the expected return for assets, particularly in stocks. Beta, primarily used in the capital asset pricing model, which is a measure of the volatility or the systematic risk of a security or portfolio compared to the market as whole. So if the beta is below the average or below 1, the company means that the company don't get significantly affected by the market movement. If the beta is average or equals to 1, is that the company is significantly affected by the market movement. Meanwhile, to calculate the expected return is by using the risk-free plus the expected market return minus the risk-free times the beta. Next topic is about capital structure. Capital structure is about long-term source of fund and financial structuring. Related to the capital structure, I learned things about debt and equity, M&M theory, and optimal capital structure. Deep diving to the debt versus equity is that long-term source of fund usually coming from long-term debt plus equity. Usually, the expected return of the cost of debt is lower than equity. That's why using more equity is riskier. By using debt with a lower cost of financing, we will also have lower WACC. And using leverage also can reduce our tax because we are paying the debt interest. But be careful on the risk of financial distress since it could reduce the value of the company, which causing the investor and suppliers walking out. Optimal debt ratio can be gotten from knowing the financial distress boundaries. The second one is the Modigliani and the Miller theory, which is the M&M theory that I mentioned before. So their theory mentions that however the capital structure of the company is portioned, its change won't affect the future value of the company, which is wrong because there is transaction costs, taxes, information asymmetry, etc. that will hinder the process and thus affecting the future value of the company. As the revision of the M&M theory, there is something called optimal capital structure. There are two factors that are influencing the optimal capital structure. The first one is the tax benefits, where the profitability appears positive, tax rate is positive, but the interest rate is negative. The second one is the financial distress, which is the volatility of the cash flow is negative, liquidity is positive, and GCG score is positive. By positive, that means that the graphic moves to the right side of the optimal debt ratio line, whereas the negative means that it moves to the left side of the optimal debt ratio line. On the 5th and 6th week, I learned about the various topics from fraud risk management to corporate restructuring. I will go through the fraud risk management first. In fraud risk management, there's something called as the fraud triangle, which is the top 3 reasons why people conduct fraud. The first one is because of the opportunity. Second one is because of the rationalization, where they think that they deserve the money or they are doing it for the good purpose. The third one is because of the pressure, which can come from the financial problem and the work itself. To prevent fraud from happening, company can work towards building the employee ethics, building whistleblower mechanism, and using technology as protective security such as hardware and software. The next one is the corporate restructuring. Corporate restructuring is aimed at stopping the company from bleeding and save the cash flow. Corporate restructuring can be done through operation restructuring, asset restructuring, which is to sell the fixed asset with low utilization, and the financial restructuring, which is to negotiate with debtors and the shareholders. There's also something called the leverage buyout, which I learned from the Nabisco case. LBO, or the leverage buyout, is buying a company with external source of fund. But this has to take on the economic scale, because if the company is too big and complex, the value will be discounted. The next one, I also learned about the dividend policy. Why dividend is needed? The first one is for the tax benefit purpose. And the second one is that consistently giving dividend shows that the company have a good performance, because the numbers on papers can be engineered, but the money cannot. So that's the things I learned from the corporate finance class from the 5th and 6th week. On the last 2 weeks of the class, we also learned about various topics. The first one is that we got the opportunity to learn from movies about financial. For example, from the Wall Street movie, we learned that greed is a good concept as long as it is used for a positive note. Greed for knowledge, for example. The second topic that we go through is the international finance. International finance is including the foreign exchange market, inflation rate, forward versus future market, where in the forward market we can buy or sell assets, and in the future market we can trading the future of the assets. There's also topics about the stock options and arbitrage strategies. Arbitrage strategies is that an investment strategy which an investor simultaneously buy and sell assets in different markets to take advantage of the price difference and to generate profit. So that topic about the international finance is also the end of my corporate finance mind map, which filled with the things I learned from the past month from Professor Sembel. It surely has been a very interesting journey for me, and I also would like to thank you for watching my video. Do not forget to leave comments and thumbs up. Stay well, stay safe, and I'll see you on my next one. Bye.